All right, let's bring in our next guest analyst, Mr. Craig Milanos. He's with a co-founder and wealth partner at the VestGen Wealth Partners up in Chicago. Craig, thanks for being on.
Hey, good morning. Wait a second, Scott. I always bet the over. Only 73,000 jobs on this print. Man, I'm a little disappointed. That's the lightest going all the way back to last year. I was calling for a rate cut in September. Maybe I should have gotten one in July.
You got a lot of people in that camp with you. That's for sure. My machine has not updated. I don't know what the heck's going on. Maybe we have to pay our bill here at RFD. But so 73,000. We were expecting 106,000. Is that correct?
Yeah, I mean, the range was 100 to 115,000. The unemployment rate here is going to be 4.2. That's up 0.1%. Everybody knew this thing was going to come in soft, but I don't think I expected a sub 100 number. We've consistently over delivered on everything, whether that's earnings from Microsoft and Meta recently, whether that was the second quarter GDP data. Everything's been coming in sunshine and roses. This is a little less rosy than people want. Maybe the market will take that as a positive because it's dovish for the Fed then. They're going to have to cut rates. But with the Dow selling off 430 points right now coming into the futures, got to tell you, might just sting a little bit going into the first day of August trading.
Yeah, those folks that took some money off the table yesterday are looking pretty smart here today. So you don't think? I mean, this will fire up rate cut talks again, for sure. And you would think that might help rescue equities. I mean, obviously we have a long day to go in front of us, but it doesn't look like that's the case right now.
No, it doesn't look like that's the case right now. And, I remind everybody, though, just because we had a soft jobs number today, one number does not make a trend. And these numbers are always subject to revision, everybody. And the reality is, if we talk about that hard landing versus that soft landing, services in this economy still above 50. You look at retail sales, still good, 621 billion. What I call non-defense capital expenditure, 76 billion. We're looking good. Job list claims aren't really that elevated, so we're okay. I just think there's a lot of good priced into the market, which means for the market to move noticeably higher, it takes great news, not good news. That's where we sit to start August trading.
Yeah, it's there's still work to be done. I mean, this economy is like an aircraft carrier. I say that a lot. It's going to take a lot to turn it around. The inflation boogeyman has really probably been one of the most hotly debated issues, and it looks as though that might be overstated. We'll see. There's some that think that's still yet to come. I think sometimes they are hoping it's yet to come for some reason. But anyway, with the inflation boogeyman, set that aside for a second because that's really been the impediment for rate cuts. If we see weakness elsewhere, and jobs is a big one for the Fed. If they see the weakness there, then maybe they get off their keister and give the president what he wants. But the unemployment rate, if anybody cares, was expected to tick up a percentage point, and it did. 4.2 is what we got, and that's what was expected. So that's out there. Average hourly earnings came in as expected as well. Year over year, just a little bit hotter than expected. So I would say, they're going to call for interest rate cuts. We'll see how the market takes this throughout the day. Right now, they might be getting a little angry because I think that's the 10-year yields dropped from 4.39 to 4.32. So that's come in pretty quickly here. We'll have to see what the market, how the market reacts over time. But it looks as though rates want to come in, and if that's the case, maybe that helps these things throughout the day. Nothing changes on a dime.
No, we'll see what happens. And what I'm going to be paying attention to in the coming weeks is I'm just going to continue to look at credit spreads, right? Remember, Scott, the smart money is in the bond market.
100%.
And always have been. And those credit spreads, I tell people, they are elevated compared to where they once were, meaning credit spreads are a little bit higher than people might think. Not nearly as high as they were on Liberation Day Part 1 from the Rose Garden going back to April when we were trading, 200 basis point spreads. But, we're up from that low reading we had earlier in June and July of 1.4 to 1.69 or thereabouts. And I think that's what we got to pay attention to. But that's for the traders and the home gamers. I think for everybody else, pay attention to the big context. The economy, not too hot, not too cold, no longer feels Goldilocks, but it's still the right temperature, if you're looking to have a good breakfast, and that's what should matter.
All right, sounds good to me. Always love having you on a Friday, especially you get the best slot Friday mornings because that's when all the good stuff comes out. So I appreciate having you on. You always got something good to say about it. That 10-year yield still coming in, 431s last year now. Thanks, Craig. Craig Blanos, he's with the Best Gen Wealth Partners. He's a co-founder and wealth partner himself there. He's in Chicago. We're going to go, well, you know what? I want to remind everybody, if you're on the SiriusXM app, you got to call in now because there's a little bit of a delay, so that one's not as smooth as we'd like. But anyway, 855-776-6147. Send us a text. Give us a call. We want to hear what you have to say. Non-farm payroll day came in a lot lighter than expected. We'll see how the market takes it. We're going to go away. We're going to take a quick break, pay some bills, and come back and talk more right after this.